So, good afternoon, all the participants, for this last moment revision for tax audit and CARO. But before starting our today's webinar, I request Ms. Raji to run our institute motto, and I request all the participants to keep their hand on their heart for our institute motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामशो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you all. So I want to inform you all that we are doing this WOW series in one Wednesday in a month, because WOW means Women on Wednesday. So all the female member, especially we are inviting female faculties, and coordinator is also female, but participant can be male and female both. So it's from the female to all. So I welcome CA Krupa Gandhi madam, and I want to thank her that he accepted our invite and ready to share his expertise on tax audit with us in her busy schedule, because now in September she is very busy in auditing and finalization and all these things. But she spared time for us. This is the great thing. So thank you, Krupa madam. So to share the expertise, I want to thank CA Ruta madam and CA Ansu to agreed for coordinating today's webinar. And we have started our one project Sub-3C. In Sub-3C, we had started Prerna also. For Prerna, we are organizing a program for female chartered accountant for practice management. They can do practice management in their office, and they can get a job or work from that. So that it started from 5th September. They already started this first course, and it is a 30 hours course, alternate day 5 to 7. So this is our first batch we are doing, and it's an online course. So in next batch, I will request all you have to take a part, because it's very popular, and the participant who are participating in that event, they are very much satisfied with the course, and all the details you can find on our website. And if you want to take webinar, if you want to be a faculty, you want to be a coordinator in our WOW series, please write to us. You can mail to us also that you want to be a faculty on any subject, or you want to coordinate in a WOW series. We will be happy to be you be there if you will be there. And now I without taking much time, that okay. So yeah, this is all the projects started by our chairman sir. Chairman sir is there, Vinayji?
Hey, ma'am.
Okay, so in this this is the Prerna. What we discussed in WOW series is also Women on Wednesday. So these all the projects has been launched by our chairman Arpit sir. In the project Sub-3C is for students, and Trust Clinic and WIRC Samvad Vishwas means it's about the whatever query you can ask with the institute. We will solve that. Like we had Zoom webinar yesterday only for KYM. That webinar was for 1 year, and all the CA who were getting problem in filing KYM and who to for the deposit submit their fees. All the queries had been solved in that. Gurukul means in Gurukul we are inviting the corporate if they want to train their staffs for any subject. We are inviting them to our institute, and we are providing the faculty to them to teach them. So this is like in WIS in Niryat series we are doing export like we had one webinar with Dubai chapter. We have one webinar with our Australia chapters. So like this in Niryat series, we are doing what the professional opportunity we have in our international uh, uh, areas. So in Tech Edge, again, it's on Thursday. In Tech Edge, we are organizing programs, webinars on Power BI, blockchain, Excel, and all the IT related series are in Tech Edge, and it is on Thursday. So you can take advantage of that. Startup Lab. Startup Lab is also that startup webinar we are doing. So there are so many things we had started this year. So you all can go to visit to our WRC website, and you can get all the details about the program. So now I don't want to take much time, and I request CA Ruta Madam to introduce faculty Krupa Madam. Ruta ji, please.
Thank you, Pinky Madam, my council colleague in WIRC. She is very active in even Vikasa and doing a lot of things for students. She has already explained about what all initiatives we at WIRC are trying to take. And I would also like to add that still, if you have any problems with KYM still persisting, please feel free to contact any of us at WIRC. So don't hesitate that if at all, even there are call centers of ICAI available to you all. Having said so, today we are very lucky to have Krupa Madam in this tax season here. One of the reasons is, let me tell you a memory which I wish to share. When I was a chairman at Pune branch, when she had been to Pune, and it was such a lovely seminar, people were not willing to let go of her. And it was really, it extended, but for a good reason. And it was on TDS. Remember, Krupa Madam, it was, there were so many questions and people were completely bombarding her with the questions, and she very calmly and coolly explained all the questions. So today we all have the opportunity to even bombard her more online. So, with this, let me give you a formal introduction of Krupa Madam. She is, of course, CA, FCA, and partner at Bansi Mehta and Company for more than 27 years. Her specific things, advisory and litigation services in direct tax with focus on banking and financial services, advisory and assurance for alternate investment funds. And definitely she will be giving tax planning also, I think. Succession planning and family arrangements. It's a different and a niche area. End-to-end consultancy and handling day-to-day issues of corporate clients, as well as she represents them and litigation in income tax appellate tribunals, tax audits including those of banks and companies, tax due diligence, and advisory on outstanding income tax demands and how to handle that. She is also into a very, very different area. Please note, she is also into quantification of contingent liabilities. I think it's a very interesting profile you have here, Krupa Madam. Among her other achievements, she is an independent director on Century Enca, a public listed company. She is, of course, a regular speaker on direct tax and corporate laws at WIRC and all other platforms of ICAI. She is a regular contributor to our WIRC referencer manual and is also a member of Regional Direct Tax Advisory Committee of Mumbai region of Government of India, Ministry of Finance. That's a wonderful. We are very glad and lucky to have you here with us, Krupa Madam. And a very happy coincidence also that some 2-3 years ago, Drushti Madam had started this WOW series when she was the vice chairman of WIRC. So we are please do tell her that we remember her as well. So thank you, and over to you.
Thank you, Pinky. I won't call you madam. Thank you, Pinky. Thank you, Ruta. Thanks for your kind words, more than what I deserve. But anyway, it's been pleasure talking on WRC and ICI platform. And I remember my first talk on WOW series was on appeals, appellate proceedings. That was during COVID time. It was really very interesting, and I think even I enjoyed as much as what people enjoyed. So now, not taking too much of anybody's time, I'll just start sharing my PPT so that we are all on same page. Is it visible?
Yes, yes, it is.
Yes, right. So, the topic given to me is, common mistakes in preparing a tax audit report. As we know, right now, all of us are in thick of, initiating, completing, finalizing, uploading tax audits of, September deadline. And there are so many things which typically come up day in and day out. So, first of all, when Pinky ma'am asked me if I would take a talk on common mistakes, I really liked it because the focus of this talk is very specific to mistakes. Instead of, I know there are many seminars on tax audits happening, but a talk on common mistakes is very focused, and to some extent it helps us overcome those common mistakes which could have repercussions later. So thank you for selecting a little focused topic on tax audit. For ease, so yeah. So first, for ease of understanding, what I've done is my main talk is on commonly found irregularities or maybe mistakes or inconsistencies. Second would be the repercussions of these mistakes or inconsistencies in adjustments in 143(1) intimation, which we all face. And some of these mistakes or inconsistency could also be a subject matter of scrutiny assessment. So last two things are actually fallout of these common irregularities or mistakes, which I will touch base depending on time available. So to first start with, our tax audit has a report, where as we all know, it is either 3CA or 3CB. Now, 3CA, as we all know, is for those SSC who are subject to audit under any other law. 3CB is for those who are not subject to audit. Now, as we know, for our audits, audit report, we have SS 700, which is on forming an opinion and reporting on financial statements. So it basically lays down auditors' responsibility to form an opinion. So in our audit report, we have a detailed opinion forming paras on our audit. Whereas in tax audit report, which is basically 3CA, we have only this para of what I've highlighted down, which is in my opinion, in my or our opinion, and to the best of my or our information and according to examination of books of account, including other relevant documents and explanations given to me or us, the particulars given in the said form 3CD are true and correct, subject to the following observation. So the scope to give our opinion in 3CA and 3CB is quite limited. It's restricted to this para. And as we all know, this is all utility based. So, there are limitations on putting comments. So under that, as we know, there are various drop downs available, which could be in form of qualifications or observations. So once we select this, what I'm trying to point out is whatever observations, qualifications, or even disclaimers sometimes which we have, we should put down under sub-paras of para 3 of 3CA, which is my second bullet. So whatever are my qualifications, observations, or disclaimers, which could affect my opinion, or which my opinion is subject to certain restrictions, must be brought down in my drop down of para 3. This is very important because unlike an audit report where I have a freedom to write a lot more things, here my scope is limited. So we should write them down in the sub-paras of para 3. Please keep that in mind. Second, as we saw, first is a name. Second clause of 3CD is address. So the important thing is our address in our 3CD should be what is communicated to income tax department at the time of audit report, and it must match with the address on our income tax portal. Often there are some mismatches. So try and avoid it. If you have to change your address on IT portal before that, please do that, but ensure that my address in 3CD is same as the address in my IT portal. Clause 4. Now, clause 4, I'm also just mind well, I'm not only pointing out mistakes, I could also be giving some inputs on how to improve our reporting. So, it's not all the time mistakes, but it could be some inputs also from my side. So just read it in that form. The next clause that I'm dealing with is indirect tax registration. Now, as we all know, indirect tax is a whole lot of registration that we write down, right? From GST, customs, import export code, profession tax, shops and establishment, name a thing, and we write that down. But what happens quite often is that what we report here in clause 4 is not all the indirect taxes which would be mentioned in CARO. So please ensure that consistency is maintained between what is reported otherwise in my stat audit and here. And also, if there are some registrations which are PAN based, now mind well, these indirect tax are largely state subject except for few. So unlike PAN, which is always alphanumeric, or GST, which is PAN based, these indirect tax are not consistent in the numbering. Some number states could have a different series, some states could have a different series. So there is no uniformity. But where those registrations are PAN based, then sometimes it is seen that they are not matching with PAN. So just ensure that we are not writing a wrong registration, or there is no defect in that registration. Now, as far as GST, now that inactive thing, what I'm referring to is the GST registration. Now, if there are often, in GST, suppose you've not filed return on your GST for 6 months or so, then it becomes inactive. But such inactive, okay, I do not report in 3CD. But even if it was active for some time, then do make it a point to report in the utility, because as we all know, now we have not only 26A, we have AIS. So AIS gives whole lot of information about your GST turnover and other things, which I'm going to deal with later. So there also a lot of them, those inactive registrations get reported. So if it is active at any point in time, please report it under clause 4, so that we are on correct line of reporting. Now, one important point I want to point out about indirect tax registration. As we all know, as tax auditors, we have limited way to get data from the client, because what we do is we ask clients questions and they give data, sometimes representation, or sometimes we collect data from supporting their documents or from websites, etc. So do make it a point that in our notes to 3CD, we write that we have reported under clause 4 based on the data or the registrations provided by the client. Do make it very clear that beyond that, you do not have control to find out. So make it clear that this reporting is based on the data provided by the client. Another important clause which has come from last around 4 years is clause 8A. As we all know, the companies have an option to go under lower tax regime under section 115BAA, which is 22% plus surcharge plus cess. Now, as we all know, first time when a company wants to opt for 115BAA, it has to file a form 10IC before the due date of return. Whereas we know that tax audit is done and uploaded 1 month before the return due date. So there is a gap of 1 month. Invariably, we persuade clients to file 10IC before the tax audit is uploaded, so that we are reporting basis actual filing of form. But it may happen for some time, for some reasons, that the company has not filed 10IC, though it has principally decided that yes, we are going to file it, but the actual filing has not happened. And the client is not wrong, because he has time till return date. He is not required to file till tax audit date. So in such a case, what should we do? Ideally, we should put a para, in our notes to 3CD, something on this line, that we take first a confirmation from the SSE that we are opting for this lower tax regime, and we will be filing this form 10 IC before the due date. That kind of, first of all, email or a letter should be taken, and thereafter we put this note saying the SSE is contending to opt for a reduced rate of 22%, and as on the date of the report it has not filed, however it may file it before the date. The reason for my talking so much on this is that if you write no in this clause on the limited premise that bhai usne abhi tak file nahi kiya hai, it will have serious repercussions on the SSE, because it could, in 143(1) it would calculate tax at the full rate, which also is not correct, and then there are a lot of other things he has to do. So if there is certainty but for some reason the SSE has not filed, take a proper letter from them, kind of confirmation, put a note in 3CD and say yes. That's the way out for 10 IC clause 8A. Now another important clause is clause 10A, which is on business or profession. Now, as we all know, this has a whole list of those codes for each business: manufacturing, then if it's mining, manufacturing, then what manufacturing, service, then various services. So here, just take little trouble to write properly, select proper codes for business or profession, and just don't select some clause which is very generic, because writing this code can to a great extent help also the SSE when they are fighting or they are contending some main object or main business. For example, see, in this clause we can select three, I think, if I'm not wrong, 3 principal lines of business. So if you have really 3 principal lines, then do take trouble to write 3. If 1, then at least go through. If suppose I'm a manufacturer, then don't just select any manufacturer. Try and come close to what I'm actually doing and select that. And very important, for example, I've taken few clauses where your reporting can really be useful, or it will point out the real business. For example, the company is fully into business of renting out property. So then you select that as a business, because in such a case, the SSE will offer that as business income. And if he offers as a business income, then he's going to claim various expenses, unlike house property where it is 30%. But among various evidences and supports which he gathers, even proper reporting, after of course verification by tax auditor, that letting out of property is my business, is a good way of actually bringing out the real business. But of course, this is subject to our verification. Another case is of, suppose a company is regularly a company which is into lending. Okay, so that will offer it as business income. So you select financing business. If this is into this, what is called 3618, it's a section for special reserve deduction for banks, then housing finance company. So they are into, 3618 actually specifies which are the eligible business for which you get special reserve, for which you have to create special reserve and get deduction. So select one of them, industrial expansion, housing finance, etc., what infrastructure, all that is specified. So after verification, you can specify that one of the eligible businesses selected. Similarly, I've given out clauses of 35 AD, those exploration, etc. Then new manufacturing company, which is 115 BAB. Again, specify manufacture and production of, etc. So write little properly. And in most important, in transfer pricing cases, your nature of business should match with the business profile of comparables, because in transfer pricing, we are doing benchmarking with other comparables who are in the same line of business. So be specific to a business base, because that will also be compared with the business profile of comparables. And sum and substance, try avoiding to write others in business, because that others is very scary. It just writing others doesn't serve any, it has no repercussions on you, but it looks very a little less meticulous as a tax auditor. The next clause is clause 11A. Now, as we all know, clause 11A requires a tax auditor to report books of account, what are the books of account prescribed and other things. Now, in 11A, very clearly the question is, are there any books of account prescribed? Now, if you know, under clause section 44A, books of accounts are not prescribed for a company. in fact, Companies Act also does not prescribe books for a company. In fact, prescribed books are only for specified professions like those carrying on legal, medical, engineering, architecture, technical consultancy. For them, books are prescribed. For company, no books are prescribed. Okay. And what kind of books are prescribed is also in Rule 6F. So please don't write yes for a company. There is no prescription for a company. Second point is on 11B, which is because 11 is entirely on books of accounts. So 11A is which are the books prescribed. So for companies, there are no prescribed books. Companies that requires a company to maintain proper books of account, but no prescribed. Clause 11B is on location of books. So as we all know now, generally all books are on computer system, or they are, if the data is served on cloud or on external server, etc. So it's important that when we write list of books of account, and the question is where are they maintained, be very particular of writing location of server. If I'm sitting here, say for example, in Mumbai, but my server is in Chennai or Hyderabad, then I must write only Hyderabad and not write registered office, because see, in good old days, the assumption was yahan pe aap hai, wahin pe books. No, that's not the case. So please write location of server when books are on ERP system, or when the server is, wherever the server is located, even where books are on cloud or etc. And if proper IP address, do mention. But somewhere please mention in your notes that the books are maintained in computer system, because often it is seen it's not mentioned. So as part of your notes, do mention that books are maintained on computer system, and writing server address is very important. Server could be wherever, it need not be the place where SSE is assessed. So please keep this in mind. Now 11C, now that's also part of books. What it requires is that tax audit is required to examine which are the books and documents that I have examined. So, be generous in filling up this clause, and don't write 2-3 line ledger, journal, basic entry. No. Don't restrict like that. Write properly what books you've seen, for example, and also the supporting invoices, vouchers, bills, confirmation, registrations, agreements. You write agreements, contracts, and finally such other documents. So this list could be fairly long. I'm not saying it can't be, because there are no restrictions, but do write generously, as I say, not just books, but all supporting documents which we typically see while doing tax audit. For example, invoices of fixed asset purchase, or registrations for GST or PT, those challans for profession tax, ESIC, so many things we see. So many times we see confirmations, etc. So do write in qualitative form that I have seen invoices, confirmations, registrations, agreements, contract documents, etc. So don't, write this and then say finally maybe such other related documents or oral confirmation. So etc. should not be used simply. The second, now the important clause is clause 13, which requires us to give ICDS details. So what it requires is disclosures under ICDS and what are the impact of ICDS. So there are two things. So one is that, are there any adjustment under ICDS and to the P&L? Because invariably, typically for India's companies, their accounting is on fair value basis, whereas ICDS are basically on IGAP. So there will bound to be some adjustments. So this clause has to be filled up properly, and wherever there are all the ICDS, so wherever it is not applicable and there are no adjustment, do write 0 or nil, don't miss it. And where disclosure, for example, ICDS 1 is on disclosure of accounting policy. So you should give entire disclosure of accounting policy, maybe as an annexure. So that is your compliance with ICDS 1. Don't skip ICDS 1 and just give only ICDS where there are impacts. So impacts is one thing, but ICDS 1 is also should be given as part of, maybe as an annexure to your 3CD, that this is all accounting policy. An important observation which I found in my practical practice is real life practice is that if there are ICDS adjustments, Do not write that this is change in method of accounting. My method of accounting is still mercantile for company. ICDS adjustments are what are required under the Income Tax Act under section 145. So this is because in some ITR, please, this has no impact neither in 3CD nor in ITR. Please do not say that because there are ICDS adjustment, there is a change in method of accounting. This is no change in method of accounting. The next important clause here, now which I'm picking up and which is of importance to all of us in all, practically all tax audits, is clause 18, which is on depreciation. So as we know, depreciation clause takes fair bit of time, especially for companies which is asset heavy and which has regular capitalization and things like that. So what is, I mean, Amol, you can have a whole session on clause 18, but to restrict myself, first of all, what I find typically is that, first of all, when you start with clause 18, please ensure their opening balance in clause 18 tallies with your closing balance of last year tax audit. Please ensure that is done. And then the important thing is on addition part. See what happens in tax audit, what we do as addition and what is done in financials as addition, there could be some gaps. So a good practice would be to have a reconciliation. So I've just tried to put a sample reco for our own internal record. This doesn't form part of any of our tax audit. So you have additions as per cash flow. Now in your cash flow statement, you will have our cash flow, you will have addition to fixed asset. So in that addition, if there are some purchase assets which were purchased say in earlier year, but they were not put to use, so they will be added. Reduce capital WIP of current year because it's not put to use, but add capital WIP of earlier year. So all these will add up to additions under clause 18. There could be many more adjustments, but these are the basic ones which we should keep in mind. Another thing is, many companies, large companies have a policy of write-off of minor additions, like 5,000, 10,000. They write it off in their accounts. And then it's written also in accounting policy that assets below so-and-so are written off. Now, as we know, under section 32 or section 43 of Income Tax Act, there is no concept of minor write-off. At one time, there used to be 5,000 as limit, but that's years ago. So what we have to do is those minor additions account should be thoroughly scrutinized in their ledgers to see if there is any capital asset, please add it. What I mean by minor additions is repairs to plant and machinery or buildings or things like that. These are typical ledgers which we should separately see and find out if there are any other assets. Now, this problem will arise where you are not the statutory auditor and you are purely a tax auditor. So this exercise will have to be done. But if you are a stat and tax both auditors, then at the time of stat audit itself, you can keep in mind that this part of my ledger is going to be part of, will be need scrutinizing for my clause 18. So do look at two minor additions by way of repairs because that could have some assets which need capitalization in clause 18. Now, similarly for deletions also, we can have a basic RICO for our file purpose. You have deletion, as we know in our financials, we have deletions in schedule of fixed assets. Now that's purely gross block and accumulated depreciation. Whereas what goes in income tax is the entire sale proceeds. So how do we do this RICO? So you have deletions per schedule of fixed asset. Whatever is the addition, profit recognized in P&L, less loss recognized, or any other difference will be your deductions. Because here we are concerned with sale proceeds, not just the WDV. If you do from cash flow, same way cash flow, and this would tally with your cash flow because cash flow has sale proceeds item. So this way we can have these recourse for our internal purpose to see that we do not get and end up having different additions in our financials and tax audit. Very important clause in terms of errors or various inconsistencies that crop up here in clause 20B, which we know is about employees' contribution to PF, ESIC, labor welfare, all those funds. Now, here what we are reporting is employees' contribution, but sometimes there could there could be, see, we should go by the bank book and the challans which are there. And challan also the date, not the date of generation of challan, the date when it's actually, paid, tallied with bank. So that errors in this challan amount and ledger should be avoided, and try matching. Do match with the ledger. As far as small companies are concerned, it's possible. In big companies, maybe some adjustments are required, but the arithmetic errors should not be there in clause 20B with the challan. That's the first thing. Second thing which I have also experienced personally is the date format. Now, we all, for example, PF has to be deposited by 15th of next month. But, sometime, 15th is not there. But suppose you have a date like 6th September and it gets changed to 9th June or something like that. Or 9th June getting converted to 6th September by DDMM. It can have serious repercussions, because if the dates go beyond, then they will have a disallowance saying that this is all beyond the due date. And there's a different angle of litigation to this, all because there was some error in date format. So be very mindful of date format, that it should be in MMDDYY, and please see that in preview version before it's uploaded. Because I've personally seen one case where we had to go in appeal and take a certificate and things like that for this kind of oversight. Then, sometimes actual date of payment, it doesn't match with the date of, it doesn't match actual date of payment. It doesn't match it. Sometimes it's reported beyond the due date. Now, in this case, please ensure that there is no extension of due date. If there was extension, then you please write the extended due date and not the original due date, because this could again have repercussions on disallowance. The next issue here, which we could have, and it's very practical, is that sometimes there could be excess deduction in PF in 1 month and it is adjusted in subsequent month. So how do you report in this? So for example, now I have received in this example, I have received 100 rupees from employee in month September 22. Actually, what I've paid is 120 because it's excess. So I will report 100 only. I will not report 120, because that 20 is now I'm going to use again subsequent month. So again, next month when I do 100, I don't report 80, I report 100. So here, when you are adjusting excess short, please ensure that these inconsistencies do not happen after, of course, verifying the ledger, because 20B is a big issue for 143(1). The next clause is clause 21A, which is amounts debited to PNL which of capital nature. Now here, what is required is capital nature, personal nature, political party, club, penalty, fine, etc. So here, we have typically loss on sale of capital asset. Now, whether it should be reported or not is a debatable. Some clients, some people report it. Really, loss is not expenditure. So if you don't report, that's fine. Expenditure at clubs. Now, expenditure at club, what is required to be reported in clause 21 is what you have spent for subscription and club facilities. It doesn't require you to disclose how much is the disallowance amount. So if there are club payments, then you will have to report them here without exception. Okay, so club payments is only a disclosure part. Penalty or fine, again, based on legal cases, if they are of compensatory nature, and after going through documents, law under which it is paid, if it's compensatory, then it is, you may not report it, but with a disclosure note, because this is not it's a compensatory nature following Supreme Court. This is not reported because it's not in the nature of offense. But this disclosure could be given. Your club payments, please do keep in mind that if it is there, then do report it, but don't stop reporting on the ground that it will be disallowed, because it's a disclosure part. The next important clause is 21G, which is contingent liability. Now here, what is required is contingent liability of contingent nature debited to profit and loss account. Mind well, debited to profit and loss account. So two things, provisions which are there in books of account are not liability of contingent nature. Provisions which are adequately made after scientific working based on proper basis is not liability of contingent nature, which again one has to go through the working and satisfy himself or herself that this is not liability of contingent nature. And another important is the contingent liability, which is disclosed in notes to account, is not to be disclosed here because that is never part of PL. Of course, I don't have to say, but I'm just repeating that by mistake, even if some junior has written, please be mindful that CL of our notes to account doesn't come here because it was never part of my books. Clause 22 on MSME, please ensure it matches with what I'm reporting in annual report. And if there is no MSME payment, then based on representation, please say that there's no interest paid as per the client and with a disclosure. But please, MSME interest must match with what is reported in your annual report. Clause 23, as we all know, is 40A2B. Now, 40A2B is payments to related party. Now, what are related parties? Related parties for 40A2B are very clearly specified in that section. Directors, relatives. What is reported in our financials is not as per 40A2B. It could either be Ind AS or it could be AS. Like for example, Ind AS, it is Ind AS 24. So what is reported in financial is much wider because Ind AS or AS even cover people with who have ability to influence the board or with whose KMP basically, with who under whose control can control other entity, who can under whose control the entity is used to working. So that doesn't form a part of 40A2B. So we'll have to do a separate exercise for 40A2B. Of course, that will depend on the client, and client has to give us the data, and based on that data we report. But don't simply copy from your accounts. Secondly, only debits to PNL have to be disclosed because 40A2B basically is what is if it's a payment to, if it's an expenditure which is excessive or unremunerative. Now, when you talk of expenditure, it is what I'm claiming. And what I'm claiming is from PNL, unless there's something from balance sheet. So please see the PNL item to report under this. Not loan amounts, loans given, loans repaid are not part of 40A2B, though they are part of your financials. Third important thing is in this clause, we are only required to report payments. So expenditure incurred by under method of accounting. So please, nowhere in your notes we are writing it is unreasonable or excessive. So that's not the scope of tax audit. That's for the assessing officer to decide. So in no notes we are going to comment. We are not required to comment. Now, another important clause is clause 26, which is section 43B. Now, as we know, 43B allows certain expenses only on payment basis, regardless of your regular method of accounting. So if, for example, typically, these what's called GST or tax duties, etc., which we do not pay at the year end, normal in accounts I would have accounted, I will claim it only if I have paid till the return filing date. So here there are some questions. I mean, there are pointers I wanted to point out that section 36(1)(2) talks of bonus, and nowadays majority of the employees are not covered under Payment of Bonus Act, and now a new concept of performance linked incentive has come up. They don't call it bonus. So whether you should report performance linked incentive here or not, again, it's an open question, depends on the client and depends on the consistent stand that they have taken. But basically, even if you report, ensure that what is allowed is only what is paid till due date of return. Profession tax of employees, though deduction is not allowed, it's tax. So if your end, if something is outstanding, report it and then show payment. GST liability, as we know, GST is paid either by cash or by utilizing ITC. So again, this should be net of ITC. Next is the leave encashment. Now, this provision for leave encashment, if you do it on actual basis, which is on global basis, it's a debatable question. Supreme Court, of course, said that clause F of 43B is constitutionally valid. But, conservatively, we should report provision for leave encashment as part of 43B, even though it's on actual basis. But legally, there's a different contest to say whether it is leave encashment payable or not. Conservatively, better to report. Another important thing which I'm sure people are aware that now, because of the gap between tax audit and income tax return filing date, there's a specific provision in Rule 6G that for payments under 43B and also Section 40 AIA, those TDS which were not paid, if you make any payment after tax audit report, but before the due date of filing of return, you are allowed to revise your 3CD. So please keep in mind that if such any client has made any payment in that 1 month window, then you can revise the tax audit report after taking evidence of payment. So this will, bring again consistency between tax audit and income tax return. Two most important thing, clause 26 has two parts. A part deals with opening unpaid liabilities. So in that part, we report only payments which are made from 1st April to 31st March. We do not go beyond that for outstanding payments. But 26B, which is the closing balance of current year, which is the balance as on 31st March of current year, we report payments till date of audit report. So please mark the difference. In 26A, we stop at 31st March. 26B, we start from 31st March and up to the date of tax audit report. Clause 27, SENVED credit availed and utilized. Now, all this while there was a debate whether we should report with GST being there. And as per the recent guidance note, which just got published on 4th September, very clearly it says that unless you are into those 6 products of petroleum, crude, diesel, petrol, aviation, turbine fuel, etc., then it is only for those employees that you are required to report. But I still leave it to you. I mean, all this while it depends. But guidance note now is very clear that it does not apply. But if someone's reporting and continuing to report, then I don't find it's going to be they should do it with a note that though it is on SENVED, we are out of abundant caution, we are reporting even ITC part here. Just mind one thing, that clause 27 is reporting for ITC opening balance, utilized, closing. But this is not same as clause 14B, because in 14B, what we are doing in the 145 is the impact, if I am following inclusive method, the impact of GST and other taxes on my income and expense. So this will not necessarily be same as 14B, and a separate exercise is required. Now coming to clause 31, which we know is on, this has various subparts. It's all about loans taken, loans repaid, payment for a particular transaction or specified events, etc., etc. Now, if you know 269 SS, very clearly, it requires, this requires loan taken, repaid, maximum outstanding mode of repayment, etc. So if there is a company, say, which is into lending, or lending business, it will have so many loans. So it is not that you can club loans of all parties into one and report. No, each transaction of each party should be reported separately, because what is required is that each transaction, the government wants to see if you're paid by account payee or NEFT or electronic mode of payment. So please don't club party-wise payments here. There could be loans or other deposits by way of transfer entries in books of account, whether to be reported or not. Again, I say it's a debatable question, because some high courts are in favor. Bombay High Court says that if it's a transfer entry, it is not allowed under this 269T. However, if you show reasonable cause, it's allowed. So it's very subjective. So loans and transfer entries under the law as per Bombay High Court is not covered. But unless you show reasonable cause, as a tax auditor, please be very careful and don't step into your litigation mode and say how I'm going to fight. Just report as an auditor. Another clause of 34, I'm not getting into the RICO part, because it's a big thing which one has to do. But just one or two observations on clause 34 are important. One is that, in your column 8, what you are required is total amount on which tax was deducted or collected at less than specified rate. Now here, I've seen in past there were instances where people interpreted specified rate as LDC rates. No, specified rate is the rate specified in the Act or the Finance Act. So we are not reporting anything of LDC, but basically it says that if the rate specified was 10% and without an LDC you deducted at a lower rate, then that is amount which should come here. So of course, no client generally they will do it. So they will be very careful. So don't report LDC in column 8 because LDC is a specified rate, because under section 197, you have taken LDC, which is allowed under the specific section. So it is not other than specified rate. Then in column 10, amount of tax deducted or collected, not deposited to the credit. So here it says that, for example, I have deducted, but I have not deposited with the government. So that is what has to come. But if you are delayed, then that's not what is coming here. Delayed deposit is not covered. Non-deposit is covered in column 10. This clause of 44, as we know, last year se aaya hai and we have been breaking our head on that. But here there are some basic things because there's no standard way, but some basic things which we should keep in mind. This is the format, of course, of reporting. But certain basic things like, for example, we do not report non-cash items like depreciation and bad debts because those are non-cash, so there's no expense involved which can have GST. Head-wise or nature-wise details of expense are not intended. You are not supposed to say legal fee so much, travel so much, this, that. No, that's not what is required. We have to prepare adequate backup working, okay, and then club expense under the headings. We are not required to give head-wise because heads are never uniform. And only those transactions which amount to supply are to be reported, others are not. So these 2 or 3 things we can keep in mind while preparing our backup working for clause 44. Of course, it's a mammoth task, so I cannot say more on that. Now, as I said, having dealt with some cases of typical errors or inconsistency, I've taken my second part is on this. What are the implications or repercussions of these errors under 143.1? So quickly to explain in as many all of us know, in 143.1, the AO can make those adjustments. One of them being disallowance of expenditure or increase in income indicated in audit report, but not taken in account while computing total income. So here, this is the clause which gets picked, which is where the tax audit items get picked up. And often, if you see my last bullet, I've written the reason when they propose make such addition, they say disallowance of expenditure indicated in the audit report, but not taken into account in computing total income in the return 143.1 small a small 4. So this is the clause under which these inconsistency of tax audit get picked up. So for quickly, what I've done here is I have mapped out a specific clause of tax audit with a specific part of the ITR. So for example, clause 20 is schedule OI of ITR other information. If you see, I've also circled which amount has to go where for our cross check, so that when you're in a hurry, we don't miss out on writing the same amounts. So here, this is the kind of addition which the proposed adjustments come. Any sum received from employees as contribution to any. Yes. Okay.
No, madam, you can continue. You can continue.
Yeah. So this, if you see my left column, I've written the typical adjustment which they propose. Any sum received from employees as contribution to provident fund, superannuation or ESIC to the extent not credited to employee. And this is the intimation says amount in ITR, amount in 3CD and proposed adjustment. So this kind of a thing comes up. And the reasons for that could be what I've written down, which we have already discussed earlier. Another thing could be the inconsistency in disclosure under section 37. Now, as you know, 37 on one hand, you have OI in ITR and clause 21, which has various items which we discussed. So if you see in OI, these are the disclosures: capital, personal, not for business, advertisement, penalty, fine, etc., etc. And in clause 21, what we have is more or less, just little more, that in clause 21, we also disclose on club payments. If you see expenditure at clubs, cost of service, etc., more or less. So questions arise whether what will happen because it is shown here. But here, if you see, this is only a disclosure, as I said. What pertains to club gets reported in the TNL section of ITR. So that also shows that because ITR doesn't cover it under 37, it is only a disclosure. They have not covered under disallowance. But if questions come up, then bear in mind that reporting club expense here is not wrong, because that's a requirement of 3CD. The next kind of, so this is the kind of adjustment for 37. There is inconsistency, any other amount not allowable under 37 claimed in OI and audit report. So there could be some figure mismatch, and these are the language which comes up. So that is where we have to map and reply. So these are, now the question is 43B. Now, as I said, 43B also ITR covers in two parts. Schedule OI clause part 10 is for 26A, I mean, row number 10 and the subparts, and 11 is on 26B. So that one has to take from our clause 26 and fill up properly. Please don't net out anything against anything, just follow the same pattern. Otherwise, this again can cause, because ITR processing is done in a mechanical way. It's not human intervention. So the moment you try mapping, netting of something, then you are in trouble, because then immediately आपको notice आ जाएगा for adjustments. Please avoid that. So this is the kind of errors or proposed adjustments for 43B that can come up. Inconsistency in amount disallowed in preceding year, current year. Again, the reasons could be arithmetical error, as I said, netting off or shuffling of amounts. After filing ITR, I want to show it in a different way. After filing 3CD, I show it in a different way, then that could also result. Or one important thing which I've written, write back of amounts. For example, I had provided for bonus, and then I don't pay that to the employee for whatever reason. There's a litigation and whatever. So in books, I'm writing back, but I have not paid him. Okay, so the tax auditor will not report it, right? But in ITR, I'm netting out. So this question could come up. So in such cases, one has to be very mindful and keep in mind how I'm reporting in ITR. Because in ITR, you have to be very careful that what is reported in 3CD is not reported differently in ITR, but on the same lines. Similarly, ICDS. Now in ICDS, we have, again, all these are in other information. You have 3A and 3B in ITR, and you have clause 13. So again, follow the same pattern as of increase and decrease separately. Just as we report separately in 3CD, do the same thing in ITR. Because what happens is that sometimes, they're netting out done. But in ITR also, please don't net out. Follow the same pattern, because I've seen such, proposed adjustments arising of ICDS because someone has netted off the amount of ICDS, and then we explain that this is the same thing. It's like 10 minus 2 is 8. And what I've reported is, and यहाँ पे 10 and 2 लिखा है. So just be consistent. So this is the kind of thing. This is about this ICDS. And other adjustments which come up, or which I've actually taken these live cases from some notices like this. For example, proposed adjustment, inconsistency in the amount of interest of MSME, then inconsistent provision for payment of gratuity 40S7, then 41 write back, or increase or decrease in profit due to change in method of valuation as compared to 14B and what is given in OI. So all these which are with tax audit, we must fill up in the same way in ITR. And some of them could also come up in your assessment issues, not much, but some of these kind of questions also I've seen that, for example, for depreciation, I'm asked to give opening WDV, map it with this, and give complete details of opening WDV. So effectively, I have to see my last year closing WDV, what went into that and which came here. So of course, last year I will have the detail, the client will have the details of assets, but those should also be adequately available, accessible if questions come up. And also for this, when we are writing these things, or rather in clause 18 also, when we are putting this additions, we should be mindful of put to use certificate, date of invoice, payment. All these things should be seen together and then addition should be reported. Because these are also the questions in my 143.3 scrutiny. 14 also, when we sometimes the kind of questions come up that you have there is a disclosure by auditor regarding probable disallowance, but if the auditor says had there been disallowance under 14, it would have been so much. So very clearly SSC has not followed rule 80 but has followed different method, but the notice says that this is what the auditor has said, now you explain. So ultimately what I have to explain is that I am following a scientific method of disallowance, and which is what I've given. So there is nothing wrong in my 3CD and my ITR. It's just that without prejudice, this would have been there. So these kind of, when we are preparing tax audit, these kind of questions in scrutiny could also come out from what is reported in tax audit. But typically 143(1) adjustments often come when there are inconsistencies in 3CD and ITR. And that is why we should be very mindful of how documents are done and how reporting is done in tax audit, as well as subsequently the client should also keep in mind for ITR. So what I've done is that similarly for 40A2B, I mean, similar kind of questions come up about related party, what you are disclosing in report and what is disclosed in ITR, mismatch, give details of payment to parties. So again, the EO is asking the same thing. What is there in RPT, in financials and 40A2B? There is a mismatch. So again, we explain that the scope of both are different. What is reported in 3CD is only 40A2B. Even on 34 and sometime, we see that there are details asked on 40AIA, what are expense detail, how much TDS you've deducted, which are the foreign payments, and how much TDS you've deducted, if not, why. So if possible, wherever there are no TDS, for smaller SSC where the data is available, we must document also with us. If there is no TDS, then what is the stand taken? Is there LDC? Is it 197? Or, of course, in foreign payments, is 15 CB also help a lot, because 15 CB is must before the client remits any payment. So all these documents also we must put on our file while reporting in 34. And that also can be of great help when the scrutiny questions come up on this. Another question nowadays, which generally comes up in scrutiny, is clause arising from our clause 40 of 3CD, which is turnover, GP, NP ratio, and other ratios. Okay, so now what happens is that you have your ITR turnover, you have worked out ratios in your 3CD, and you also have turnover as per GST. So often, as I mentioned in AIS nowadays, GST turnover is also reported. So questions often come up about why is it not matching? Why? I mean, why is your GST? I mean, that comes from GST department. They are showing so much in your 26 years, and you are not paying GST. Or you are यहाँ पे पूछेंगे, you are showing so much in GST, you are not paying tax on that. It could be both ways. So the important thing is when we report our ratios on turnover, GP, NP, etc., we must document it properly, have proper working of where each figure has come up from, so that even if questions come up, we can explain to the client. Also, we can help out the client in case they need any other help. These kind of questions often come up. These are basically scrutiny notices which have come up, I've pointed out, because many of these things are also in our Form 3CD. So proper reporting in Form 3CD with documentation also helps in the scrutiny assessment of the client. So not taking too much time, but before I wind up, I have one general statement, general advice or what practice we can follow is that in 3CD, because of schema, it's a utility based, we cannot report everything. So it allows you to file notes. So apart from 3CA and 3CD, apart from financials, wherever we want to make a statement or we want to point out certain stand we have taken, it's a good practice to have the notes prepared, signed notes, and upload with the form, so that the AO also knows that this is the stand the SSC has taken, and that there is not always that there is a mistake. So it will be a good practice to write in notes if a particular stand is taken by the SSE, and also in consensus with the client, I mean the auditor. Also have proper documentation ready, and of course, finally, a proper MRL on various things on which we have taken client has represented, and we have restrictions to verify. So these are few things which you can keep in mind to avoid errors or inconsistencies, and that should, I think, help us in completing tax audit a little easily. Thank you so much.
Thank you, Krupa madam. It was very nice. You had summarized all the things, whatever required and whatever mistakes we are doing in tax audits. So it was great. And if you have you can share your PPT, madam. If you can share with us, it will be great, because all there are very crispy things are given, so we can easily take from there. And now I request CA Ansu to give a formally vote of thanks to our Krupa madam. Our next speaker, CA Padmashree, is also there. Padmashree, you can switch on your video.
Thank you.
If any question if any question is there, please ask that first. Also.
Yeah. So, ma'am, thank you, Pinky ma'am. Krupa ma'am, there are two questions. Actually, there are three questions which are there. First one being under clause 13. The question is if there is any adjustment on account of NDS, which is made in the financials, do we need to omit that from the taxable income impact, or they need to be reported?
So good point, because there is actually a difference of opinion. Really speaking, India's adjustments have to be excluded in our income tax computation if they are at variance. But our firm's view is that we report India's adjustment in clause 13 only to the extent it is covered under one of those ICDS. Don't report all India's adjustment in clause 13. That's our firm's view. That report adjust in your ITR, but everything is not in ICDS, because, for example, we don't have ICDS on lease. We have India's on lease. So how will you report that? I'm just giving an example. So ideally, cover only what is covered in ICDS and balance you take in your computation in IT.
There's another question saying that if there are some repairs and maintenance, which is treated as capital in nature by the tax auditor, so do these items need to be included in the depreciation schedule as per the Income Tax Act? And we have to disclose it as a reconciliation between financials and tax audit report?
So here what happens is that suppose the tax officer treated something as capital expenditure. So it depends on if I've accepted that and I've not gone in appeal, then I should add it and start edit and take it in addition. But invariably, if they're large amounts, I will file an appeal saying that these are revenue expense and don't add it to capital. So in that case, I should not take it in my addition. It depends on my stand. If I accept and don't file appeal, yes, you'll have to take it in additions.
I think there was one more question which was asked about elaborating related party debit to PNL, but I think that ma'am has already answered that, it's different from what is there in the financials.
Yes.
Right. The second one is clause 16. The question is whether income which is not credited to PNL account, should we report interest and other income credited in proprietor's capital account?
So this is something ideally, why is it? So it depends on why it's directly credited to proprietor's capital account. I mean, because it's a capital account. So there maybe just put a disclosure and be done with it, because there'll be reasons for taking it directly to capital. I'm not sure about what are the exact facts. What are the you report such income? I'll tell you. Typically, you report incomes which are typically of income nature, but clients have transferred to some balance sheet item. Those, for example, in past, people used to directly transfer some income to reserves. Now,
Madam,
of course, it's not
Madam,
possible.
I think he want to say that in case of proprietorship firm, if I have a interest income from my savings account or my FD interest account, which is not a part of business
then
income.
then it will not be. Don't report
So
because
when-
I'm doing
and
tax audit.
I'm doing tax
only
audit of my business.
Ah,
only.
exactly. I'm
So,
doing only for
yeah.
business. Yes.
Yeah.
Yes. Yes. Very right.
So that's
It
why
is
he is
come.
saying that whether I have to report that interest income and other income is credited to proprietor's capital account.
No. Non-business item anyway, I'm doing only for business segment. No? So we should not report. We should not report.
There's an interesting question. I think they're asking what should be the turnover in Form 3CD for F&O business.
There is adequate explanation in our guidance note, if you see. It's there in the guidance note. I forgot the para. I'll point out that para. It's there. Guidance note explain F&O. But that would not be mistake. Earlier people used to take stand of only the difference. And what the guidance note, I'll send the para. I am aware. For shortage of time, I'm not dealing with that. But there's a proper explanation guidance note. I'll give it later because then the other speaker's time gets affected. I'll give you.
Sure. There are a couple of more questions, but I think, ma'am, Pinky ma'am, if
You
we
can send it to me if you want.
Yeah.
You can send it to me. Okay.
Sure. So,
Two,
I
three
would
questions
like.
are there. Two, three questions are there. We can take that, or we have to
Okay.
report from.
Okay, then take it.
From clause 26B, do we have to report payment detail from 1st for 2022 to return filing date, or from 1st for 2023 to return filing date for assessment year 23-24?
Which part? 26B, right?
Yes.
26B. No, what is paid during the year, you don't report. What is outstanding on 31/3/23. And then from there, whatever is outstanding. Up to return filing. Because what is happened during the year is already gone. No? What is outstanding only we start with.
So, one last question of Vikas Bhayati. Client is proprietor and in tax audit, he has several branches in the city. One of his branches looked after shop. He pay salary to his daughter-in-law for this purpose, whether she is included as a specified person.
Paid to daughter-in-law. Relative में आ जाएगा.
हाँ, proprietorship में है तो madam.
Yeah,
it will be covered. No?
Yes.
Yeah, it will be covered in specified. Okay. So, I think we had covered most of the questions.
So I think I would
Yeah.
like to extend vote of thanks to.
Yeah.
Thank you so much.
I think this session was really wow, ma'am. And on behalf of the WIRC team, the attendees present online, I would like to extend a big thank you to Krupa ma'am, who shared important insights on today's topic, especially during this tax audit season, which is very helpful. Also, ma'am, thank you for taking out your time to be with us today and for sharing valuable experiences and expertise on this topic. We're grateful that you have shared whatever knowledge you have with us today. And we're looking forward to future opportunities to learn from you. Thank you once again, ma'am.
Thank you so much. And my thanks to my team also, who really came up with so many ideas on what are the practical problems we face. So thanks for inviting. And my
Yeah, the PPT was very nice and very crispy, ma'am. It was very good PPT.
Thank you so much. Thank you.
So, ma'am, if ma'am, once request, if you can read the Q&A and you can type the answer over there, so it will be beneficial for all.
Okay.
In Q&A, there is four, five question is there. So please, ma'am, type the answer over there. Yeah. Thank you, Krupa ma'am. And welcome, Padmashree.
Hi, Pinky ma'am. How are you?
Hi. Fine. And I think one after one, two bumper session is there. So our second speaker is here, Padmashree, and I knew 100% it will be also very good and learning eye-opening session will be. So I request Anshu to welcome her and give her introduction.
Thank you, Pinky ma'am. It's my honor to introduce our next distinguished speaker, CA Padmashree Crasto ma'am. She's a chartered accountant with over an experience of 20 years in the field of audit and assurance practice over several industry verticals, that is insurance, financial services, manufacturing. She's presently a partner with BDO based out of Bombay. and she has completed her bachelor's in law and diploma in system audit. She possesses in-depth knowledge on Indian and international auditing standards, Ind AS, IFRS, company law relating provisions, IPO related matters. And along with her profound wealth of knowledge, she has also contributed by conducting training sessions at various forums on audit tools, technology, qualitative methodology. She's also contributed to several WIRC publications such as Technical Guide on Financial Statements of Non-Corporate Entities and LLPs, e-handbook on role of chartered accountancy firms to ensure compliance with SEBI. She's a technical reviewer for ICA Awards for Excellence in Financial Reporting and is presently a special invitee of Center for Audit Quality. She's also a member of Corporate Law and Governance Committee and India's Committee of WIRC. Without further ado, I invite Padmashree ma'am to enlighten us on the topic common mistakes and precautions to be taken while preparing financial statements, requesting all the attendees to give a warm welcome to our extremely learned and distinguished speaker.
Thank you so much, Anshu, and thanks, Pinky ma'am. Good to see you always. And hello to all the participants who have taken out time from the busy schedule to actually, I would say, brush up on the knowledge and be ready for this next 15 days, which is actually very, very crucial. And I know how much sleep we get, so we all have dark circles under our eyes. It's part of our profession. It's part of our job, I guess. Okay, so there are the topic that we are going to speak today is about common errors in financial statements and preparation of FS. Along with this, so this I have broken into 3 pieces. One is what are the things which are actually, maybe it may sound very routine, mundane, but then certain things that we have to remember. I've kept it very simplistic, not very heavily technical, but more focusing on what are the practical issues that we face on day-to-day basis and what is it that the last minute that we have to take care, which we tend to forget in the, hurry-burry, if I have to term it like that. So I have kind of listed down few of the observations in Schedule 3. So this is a compilation from the FRRB, QRB report, personal experience, everything put together. Signing of financial statement, I have some interesting questions and I would like some answers in the chat when I put up the questions. Then deficiencies that are observed in various elements of FS as per the QRB report, FRRB report. And then lastly, what are the specific observations in the accounting standard? So please feel free to type your questions as such, or or ask any questions at the end as you wish. Okay. So here we begin. First is observation in Schedule 3 and also on the signing of the financial statements. Schedule 3, if I have to put it this way, that if it is a company, we have to use Schedule 3, and if it is a non-company financial statements, we all know that earlier it was technical guide on non-company FS and LLP. Now there are 2 guidance notes, one on company financial statements and then one on non-company financial statements and one on LLP, right? So it's very, it's based on Schedule 3 itself, but then not as elaborate as Schedule 3. However, it is to bring into consistency and also to ensure that the accounting standards are appropriately applied. I think in the WOW series, we earlier have had one session on this non-company FS also, and detailed and deliberated the accounting standards and other standards that are applicable to them and how actually we have to go about it. So first, if we have to focus on Schedule 3, investment in subsidiaries, associate JV. This disclosed separately from other than financial assets instead of under the head financial assets. This is a common mistake that you generally find, that the classification or the reclassification of certain things which have to be taken care of. So from the consolidation perspective as well as for the individual perspective. So when you are investing in subsidiaries, associate and joint ventures, so this has to be under the head financial assets. So this disclosure is something that was inappropriate in many financial statements. Financial statements on financial assets, that is loans, the loans were not classified as per the requirement, which was specified whether these loans were secured, unsecured or doubtful. So if we, think about the disclosure of loans. It very clearly says that secured loan, unsecured loan, and then there is another element which is doubtful. So I'll tell you what happens. When we actually distinguish between, say, 100 rupees is the loan, out of which 30 is secured, 70 is unsecured. And then there can be an element of doubtful within secured and within unsecured. So the doubtful has to obviously match with the provision. Sometimes when we look at the financial statements, the doubtful does not match with the provision that is made. Provision is more than the doubtful. So there is a internal some grouping mapping error that happens because of which this doesn't come out very clearly. So mentioning the security, mentioning what is unsecured, and also tallying the doubtful along with the provision is something that is very necessary. Further, the nature of other advances was also not specified, and the amount that was shown was quite material, consisting of, say, 86% of loans and advances. So it is so that in Schedule 3 there is a general guidance. If you see that any item which is very material has to be further broken down. So if you have further elements into it, then you have to break it down and actually you have to show it in a proper manner. Okay. Then there was this toll collection receivable and receivable from authority, which is in respect of amount due on account of services rendered in the normal course of business. Accordingly, the receivable from authority and toll collection receivable were in the nature of trade receivable and should have been classified. Now, this is a very typical case. So there were some, collection rights that were assigned, and those become actually the trade receivables of the company. So those were not properly disclosed. Many of the balance sheets, what we see is PPE is still shown as fixed assets. So we have to actually change our terminology also. It's trade receivable and not any more debtors or accounts receivable. It's PPE and not fixed assets anymore. So all these changes we need to actually incorporate and ensure that these are appropriately done. So PPE disclosure that was done was not in accordance with Schedule 3. Okay. Then the next point was more on expenses on acquisition of intellectual property rights and licenses. So these actually relate to more of the intangible assets. So when you have acquired, then for the project under development, which is classified as capital WIP instead of intangible asset under development. Now, if we look at Schedule 3, when we have intangible asset under development, we have to give the entire breakdown of project in progress, suspended, and also the aging and all the tables. So if one classification goes wrong, then the rest of the classification also goes wrong. Operating cycle of asset and liability, which was determined on the basis of duration of each contract instead of determining it for the company as a whole. So this was another general thing. So what happens is, as per Schedule 3, if you see, operating cycle is defined as which is actually relevant to the company, or 12 months if nothing is determinable otherwise as such. So one thing that we generally notice is that in the background of the company, you have to write what is there in the company and what is the company into. If those things are not clearly defined, then what happens, you don't know what is the operating cycle and you are not writing about the operating cycle. And you don't write the operating cycle properly. So the classification of current assets and current non-current assets, or current liabilities and non-current assets, non-current liabilities go for a toss. So defining the operating cycle becomes a very important point. Then the advances given to government authority, it was classified on the basis of amount held with different authorities instead of disclosing them as per their nature. What do we mean here is that there are various, advances that are given to various departments. For example, income tax and GST and others, as the case may be. So that should not be classified on the basis of amount held, that is for the periodicity. Actually, if you see, advance tax is always current. Provision for income tax is always current. Okay, and provision for the last month GST is always current if something is payable, or some demand from the tax authorities is always current. So it cannot be like, if you have not paid and made a provision, it cannot be shown under non-current basically. And advance tax and things like that are never non-current, they will always be current. So these kind of classification differences also emerge various times. Sometimes what happens, the client actually books the income or the expenditure under various heads. So the reclassification itself becomes such a big task. And then once we reclass into the correct line items or the schedules or the groupings, then we have to assess like what is the current portion and what is the non-current portion. If I take an example, borrowing, you know that if there is a term loan or a long-term borrowing, then you have two pieces to it. It is current maturity of long-term borrowing will become current, and then other piece will become non-current. So those kind of classification, now I'm not getting into 109 there, but however, these kind of classifications have to be properly done. And this is something that is very common amongst many companies that we see when we look at the balance sheet. These are the things that will be very much visible there. Bank and other finance charges, which are in the nature of other borrowing cost, these generally get classified as interest expense, which is not appropriate. Then exchange difference on foreign currency transaction and the translation, these cannot be included under cost of raw material consumed, because forex fluctuation or forex transaction have a separate line item, and that has to be shown separately in the financial statement. Then the profit on lump sale, this is an exceptional item. This is adjusted before charging of depreciation cost and finance cost, which is not right. It has to come below the line and it has to be a separate line item in case of accounting standard financial statements. So these are some common things. Other than these common things, what is it that we see is format, and then the classification of current, non-current, as we spoke about. So these are some very common things if you see in the entire QRB, FRRB reports, that main things that are there as an observations in Schedule 3. Now let's come to preparation of financial statement. We all know that preparation of financial statement is very important, and for us as auditors, then review of these financial statements become very important. Ensure compliance with Schedule 3 if it is Companies Act, if it is company. In case of non-companies, the guidance note on non-company FS or the guidance note on LLP would help you to actually determine the entire format and put it into the perspective. Balance sheet, profit and loss, cash flow as applicable, and notes to accounts. These are the main 4 parts. You can call it notes to accounts or you can call it schedules, or as the case may be. Now it is called notes to accounts as per after the latest Schedule 3, right? What is mostly missing is background of the company, accounting policies. Whatever is the accounting policy, sometimes what happens is that practically what we see, people take the largest of the listed company financial statements and try to copy paste from there. So say for example, you are picking up TCS or Infosys or a very large company, HDFC Bank or something like that, and then you are trying to copy paste. So you will spend more time deleting what is not applicable rather than actually picking up what is applicable. So we have to sensibly make use of the comparative financial statement so that we can do it quickly. Now, applicable accounting policies. What do we say about applicable accounting policies? There are 2 approaches here. One is write all accounting policies, whether the company has it or not, and then give disclosures only for the items that the company has. Okay. Second approach, give accounting policies for the items only that the company has and give the disclosures also. And others you give as not applicable or you don't give. Now, both approaches exist. However, Schedule 3 tells you very clearly that do not overload the information in such a manner that the user actually gets lost in reading the financial statements. So appropriate choice has to be made as to what is it that is more apt for the given case. For a small company, we can't have say for example some 60-80 pages notes, and half of it we are writing the accounting policy, then we are writing this is not applicable. We are writing full 3 pages on hedge accounting and then say this company does not have hedge. So something like that, this can't be. These are very thoughtful things that we have to do. It is ideal that we have something like an illustrative financial statement, an Excel sheet which can be easily filled in. And if you can, say that these are the items that are not applicable, then that gets hidden or something of that sort, some macros we can build. And this is something that we have to carefully ensure. Other side of the coin is, for example, revenue. Inside revenue, you will have revenue from operations from two different kind of operations. Say one is export and one is domestic sale. I'm taking a simplest of example. And other income has dividend and interest. Okay. So now your accounting policy should cover all these four items. Many a times we see that there will be something about the export, there will be nothing about domestic sales, there will be nothing about the other income, that is dividend and interest at all, or about one item it will be there, and then when discussed it will be said that okay, this is a minor item, it need not be there, and things like that. So it is necessary to ensure the precinct of materiality also, but then in terms of income and the major items of expenditure, we need to ensure that necessary accounting policies are clearly brought out. Next, what is the intricacy, or what is the problem in the accounting policy? Say, for example, it's a service company. You don't have inventory at all. So you don't have to give an accounting policy for inventory because it's not there at all. Writing the whole inventory policy and then writing that it is not applicable does not make sense, right? So these are the kind of things that we have to take care of. Next, coming to the example of, say, a foreign currency or a forward and future and hedge. Give the elaborate disclosure only if the company has. If the company has nothing, then you can finish it in one line which says that it's nothing there. Specifics required, we discussed about. Then completeness. It is necessary for all of us to check whether the financial statements is complete enough. What is complete enough? Whether the accounting policies and the disclosures, whatever has to be there, whether everything is there or not, is very important question. How do we check that? Make a list of accounting standards, keep checking for disclosure under each of it, make a list of all the laws and regulations applicable to the company, then keep checking about that, whether the disclosures are properly given, and also additional disclosures as required under Schedule 3 or as required under the specific act. We have to have that completeness checklist. So there are lots of checklists that are available. I think WRC has also come up with, Accounting Standard Board and WRC has also come up with audit checklists. So please make use of these material. You can convert it into Excel or Word and then start using it. But then completeness has to be ensured. The common things that get missed out is lease disclosure. Okay. AS15 disclosure, everyone gives. But then depending on the number of employees, that is 50 or less than 50, the disclosure changes. There is a large amount of confusion with respect to what is to be disclosed when. And then there is also, when full disclosure is given, certain elements like experience adjustment, leave encashment, plan assets table, these kind of things generally get missed out. So these things have to be ensured. Another thing commonly left out, you can say, is that lease table, which we give minimum lease payment and then tally with the P&L, and then 0 to 1 year, 1 to 3 year, 3 to more than 5 year, and things like that. That table generally gets missed out. And also, in terms of accounting standard, then it is more from operating lease, finance lease case. And in case of Ind AS, it's the complete, right to use lease and other disclosures that get missed out. Related party, very important. What gets missed out is the listing of the related party. Two interpretations exist here. One is related party, list out all the related party, then give transactions with those which are there during the year and at the end of the year. Second interpretation exists, no need to list out everything, only with those you have to disclose. Both are done, both are existing, but the better way to do it, as per me, is that list out all the related party and then give disclosure for those transactions or year-end balances if you have any. So these kind of, minor things, actually debatable things often come up, and these things have a tendency of getting missed out also. Then the next important thing is about casting. This we all do, but then in the era of laptop era, Excel era, what happens is sometimes the last two digits gets round off, and when you cut it into, or by a formula, when you convert it into lakhs or crores or thousands directly by a pay special function, the last two digits add up, and then if you see on the face of it, the total of the last digits don't match. And sometimes the totals match in the face of the balance sheet, but then it doesn't match in the schedule. So when doing casting, it is, frontward and backward, both we have to do. At times, many a times it so happens that the casting doesn't tally. So this has to be very carefully looked into. I know it's a lame point, but then it does matter, because these are the things that will actually add up to the beauty of the financial statements. Rounding off. We know that as per Schedule 3, there are different rounding denominations. Earlier it was may, that means you were having a choice whether to do or not. Now it is shall. So based on the turnover, you have to round off to the specified digit, thousand, lakh, and crore, right? Now what happens is that financial statements and schedules are in, say, lakhs. Notes also has to be in lakhs, and previous year number also has to be in lakhs in the notes. Otherwise, it is very, very inconsistent. For example, you have 250 lakhs as revenue in the P&L. And when you go to notes to accounts, you are giving some disclosure for revenue, then it is full amount. It doesn't actually give a good sense. And then you have to actually give a proper disclosure in that sense. Another point is when you are making an audit report, and if you are qualifying the audit report, you have to use the same denomination. Now, the common question that is asked is, where is it written? Now, this thing is not written, but this is something which is understood. If you have a financials which is in 1 lakh, which is in lakhs or crores, then it makes sense to give the qualification also in lakhs or crores and not in full figures. Because when the person starts reading from the auditor's report, and then he goes to financial statements or otherwise, so there may be a confusion. This is from the consistency point of view. And from the presentation perspective, the last but not the least thing is the consistency of font, figure, size, spacing, etc., etc. Now, to be very honest, when I was doing articleship, if I have to put it this way, that this thing was given very much importance, the final print was to be taken, we had to check alignment, we had to check the font, we had to check the size, we had to check the obviously the figures and things like that. Now what happens is that many a times the financial statements these days are signed digitally also. So some pages are spaced out in a different manner, some pages are inconsistent and things like that, which causes issues, and which also actually the comma or the style of the numbers also get captured differently in XML, and there may be weird queries from the regulators. So this also happens. So you need to have pay some attention to this, and then you need to ensure that all these things are appropriately consistent. Now, when we talk about all these things, the last and but not the least thing in preparation of financial statement is your UDIN. When do you generate UDIN? You have to generate UDIN within 60 days of signing of your report. That is what the announcement says. As per the recent announcement, you can't revoke your UDIN after 48 hours, right? The descriptions that you give in the UDIN is very important, because when you say general purpose financial statement, it has to be general purpose financial statement. Do not term everything as certificates, because that's one common practice that I have seen. Special purpose financial statements have to be termed so, and the figures that we put, and if there is a last minute change in the, say for example, share capital turnover, something like that, then we have to ensure that it is corrected if there are any changes. We can't let it go as is, right? So that is another very important point. If we are generating UDIN later, okay, signing the financial on the same day, please exercise caution how it can be printed. It cannot be printed, right? You have to write it by hand. Your UDIN has to be written by hand in those cases. Otherwise, you're very clearly showing off to the entire world that you are doing backdating signing, which is completely inappropriate. If you are generating later, so that means that day you have signed the financials, you have generated the UDIN later. So UDIN is another thing that you will have to at all times take proper care of. So this is some tips about preparing the financial statements. I'm not going into the format of Schedule 3, but then some tips on the preparation of financial statements. Let's get into the signing of financial statements, right? Provisions of Companies Act, it says 134(1), financial statements including consolidated financial statement has to be approved by the board before they are signed on behalf of the board by chairperson of the company if he is authorized, or two directors, out of which one should be managing director, and CEO, CFO, CS. Now in many companies you don't have all these designations, so two directors are enough, right? Now please read the last line, which was a much controversial line. If you see, by submission, before submission of, for submission to the auditor for his report thereon. Now if you go by law, the company has to prepare the financial statement. It has to first approve in the board of directors. Then it has to come for audit. We have to audit, another board meeting, approve, and then AGM. Literally speaking. But what happens? For the sake of convenience, we start auditing. On the date of board, we actually ensure that we issue our report on the board date. And then that is the meeting at which it get approved. And that is the date on which the approval of the accounting financial statements happen. What is the catch here? We are not supposed to sign before the board and the directors or the designated people sign the financial statements. This has to be very appropriately exercised, especially if you are actually using digital signature. You have to sign after the board signature. Another thing is for UDIN, if the board is on, we cannot generate the UDIN. We should not generate the UDIN before the completion of the board meeting. Because if there are any changes, then we should say that, okay, this was done, and then the UDIN is generated, because board has to first approve the accounts and then only auditor signs. If you do it before, then it will be seen otherwise, because there is a date stamp for these things. Okay. Provision further, section 158 says that DIN number has to be provided. So there's a common observation that DIN number and full name was not properly provided. So this becomes a major non-compliance. So we have to take care of this kind of requirement. Now I would like, from the next slide, I would like some answers from everyone. So this is another observation from the annual report of the company. It has been noted that auditor has signed the audit report at one place, while he has signed the financial statements on the same day at a different place. So I signed a report in Mumbai today, and I also signed a report in Delhi today. Practically possible? Yes, it is possible, but then we have to be able to demonstrate that. So it's possible that you sign it on the same day, director signs it in Mumbai and I have to sign it in Delhi, but then it has to be demonstrable, otherwise it fails that you both have signed on the same day. From the balance sheet and P&L in the annual report, the following has been stated, that is only director and director. So basically, what do I mean to say here? This is the section can go through, but specifically, what is the point over here is that, for and on behalf of the board of directors, name of the company is in. This has to come very clearly. You can't just say director like this. Now, these are minor things, but they do matter a lot. So this has to come very specifically, right? So let us go through some, repetitive questions or FAQs, and I would like some answers in the chat or Q&A, as the case may be. Can the audit report be digitally signed? Yes, no. Can we see some answers, please? Yes, yeah, absolutely. Audit report and financial statements can always be signed digitally. There is no, prohibition on not getting it signed digitally. Yeah. So the Audit and Assurance Board has already circulated an announcement which says that you can sign digitally So when you are signing digitally, you have to be careful about the UDI. Okay. Next, can financial statements be digitally signed by the auditors as well as the signatories from the clients? So what we are trying to ask is, both have to sign digitally, or one can sign manually and one can sign digitally? Any answers here? Either is possible. Yes. Validity of document does not get lost if someone signs, if someone does e-signing, digital signing, and someone does a normal signing, but it is highly recommendatory that both parties use the same mode. It still is possible, but then you have to use the same thing. What if some directors have digital signature while some not? Can mixed be followed? We are saying that it cannot be followed, but then it doesn't tender the document illegal. However, it is better to do the same mode, because then there will be issues with respect to the same. Whether auditor stamp and initials are required on every page of the financial statement. Any answers? Stamp required, initial required, both required? No, someone says no, someone says initials are required. Okay, I see many no. In case financials are digitally signed, then there is no requirement. Otherwise, it's a usual custom and practice that initial and stamp is put on every page. So that is for identification purpose that I have verified each and every page of the financial statement in hard copy. Whether auditor can sign the financial statements and audit report on different dates. Yes, no. Yeah. Yes, no. Any answers here? Is it possible that I sign the financial statement on a different date and audit report on a different date? The date of signing of financial statements by the board and audit report generally cannot be different. It needs to be the same date. That means I have to sign both on the same date. But it is possible that the board signs it on a different date and I sign it on a different date. However, for the intervening period, I need to do my subsequent events. It is possible for the board to do differently and me doing differently, but I can't put two dates on the financial statements differently and the audit report. So whether the board of date of signature of the board of directors and auditor need to be the same date on the financial statements, I think we just now discussed. The board has to approve first and we have to get it. So once FS has been approved, then we have to sign. So we can sign it later, but we can't sign it before. If you saw one of the recent cases, which was very much floating on various social media, it said that the auditor signed the financial statement before the board of directors, which is not appropriate. Whether auditor can sign the financial before the board of directors? No, it needs to be approved by the board of directors. Which financials are to be signed first? Subsidiary or the holding company consolidated by FS? Subsidiary or the FS holding? Which one? Which needs to be signed first? Answers here? Subsidiary. Okay. Any other answer? Consolidated subsidiary. Okay. So basically, consolidated financial statement is prepared if, so there are 2 to 3 scenarios, right? One is subsidiaries are audited. Second is subsidiaries unaudited. Third is management prepared accounts, correct? So if subsidiaries are audited, and then console is done, then it is necessary that the subsidiaries get signed before or on the same date and console gets signed. Subsidiary cannot be after console, right? And if it is not audited, then it can be signed anytime, because then we have to put it in the other matter paragraph in the console financial statements, right? Whether standalone and console FS are to be signed on the same date. I know some of the questions are very silly and petty, but then, it's necessary to think in all directions. Whether it has to be signed on the same day. So someone says no. Anyone else? Yes, no. Both has to be same day or different date? Not required. Absolutely. Standalone and console can be different dates. Standalone subsidiary can be different dates, and then console can be later. It is possible. But if the dates are different, there has to be different board meetings which approve these financial statements. That is very necessary to remember. You can't sign saying that day we approved the financial statements, we are signing today. No, not possible. There has to be a separate board meeting in the given case. Then only it can be signed on different dates. What if out of the total directors, one signing director is outside India and other director is in India? How do you sign the financial statements? This is a very common thing. I don't know, but then it so happens, on a lighter note, a director wants to go out of country on a vacation only when he's supposed to sign. I've seen this in multiple cases, and in multiple queries people have asked this. So I think this happens very often. How do you sign the financial statements? Digital? I have a couple of answers here. One is the director who is out of country. So the person who is in the country signs first, person who is out of country signs second, and then the auditor signs. That is one set of answer. Okay. Now, the person who has gone out of country, there is this is a IT kind of an interpretation that I recently came to know from someone. Say, for example, the person has gone out of the country, in which digital signature signing digitally is invalid. Okay, there are countries where digital signing is not allowed, only physical signing is allowed. Sitting in that country, if you use your IP and use a DSC, then I am told that the signature has no value. Now, this is something that is very, very technical and needs more analysis, but I heard this, so I thought I will mention this. Another thing is, if the director is out of country, someone sitting in India cannot use his DSC and sign, because the IP address that you will get is of this country and not the other country. So these are very technical points, and you need to be considerate of these things. It can be, so the earlier answer that I had put, I think this conversation happened only yesterday late evening. So that is why I'm bringing it out in the discussion. So I put the response as it can be signed same digitally. But then this is the intricacy that I came to know yesterday late evening. Whether CS is required to sign the financial statements. Yes, no? Yes, no? Any answers? No? Yes, if available? Yeah. So if the company secretary is appointed, then he or she has to sign, and it is mandatory for them to sign as per section 143. Okay. What if company secretary is not appointed, or company secretary has resigned before the financial statements are signed and new company secretary has not been appointed? Then does the financial statement become invalid? Does the financial statement become invalid because company secretary has not signed? Yes, no? Yes or no?
It will be invalid.
So if company secretary is not appointed or he has resigned, when a financial statement does not become invalid if the temporary vacancy is being filled by the board in the earliest possible date. So that's possible. It's not invalid. Okay. But they have to give a
But
note
if,
that
but if they don't fill the temporary vacancy in that case,
then also financial statement doesn't become invalid. So the practice is there will be a note in the financial statements, and then generally as audit firms we put under other legal and regulatory matter that the company is in the process of appointing the CS. So that becomes a kind of qualification that the CS is not yet appointed, but that doesn't hold the financial statements illegal, invalid, I mean to say. In case director signing the financial statement is a non-resident director and will be signing the financial statement outside India, can auditors and directors sign the financial statements on different dates? Is it possible?
yes,
Is
but
it-
director should sign first, then auditor should sign.
Yes, yes. If auditor signs later, it is possible. However, it has to be signed by the directors, and also there has to be subsequent event that has to be done. I know these were the questions on signing of financial statements, because these are queries that often come up, and there's always a confusion floating around these things. Few observations in the accounting standard. If you see what are the elements of financial statements which actually got the observation, you can see number one is observation related to assets. So classification, non-proper, accounting policies, various other things relating to classification is the biggest chunk. Observations related to equity are 3.79%. Then 29.55 is observations related to components of P&L. So non-proper disclosure, if it is exceeding the certain limit, separate line item in P&L, all those things actually, and the inventory disclosures, all those constitute issues in P&L items. Then 17.42% is related to other disclosures. Other disclosures are various notes and other matters which are inappropriately disclosed. Then comes to 9.85%, which is actually related to CARO. Lots of things not properly done in CARO. That was another kind of major chunk of observation that was there. And 3% was observation related to auditor's report, that is drafting, placement, CAM, all that stuff. And lastly, observations related to liabilities are minor. So relating to assets, P&L and CARO are large amount of observations. Then this is summary of non-compliances under various accounting standards as per the QRB report. I have not put up the Ind AS chart here, but there is a chart available. So the highest non-compliant matters is under the Companies Act. So various disclosures, CARO, everything is actually, CARO is 7.6%. Various matters as required by Companies Act not properly done or non-compliant is 17.9%, is something about Companies Act. Then it is AS3, cash flow. Cash flow is the next topper, which actually there is lots of non-compliances. So major non-compliances here are relating to the cash and cash equivalent portion, classification, investment activities, and the other operating activities and those things like that. So all those are the next type of issues. Then the next is AS15. As I told that these disclosure problem. There's a lot of problem in disclosure of plan assets, tally with the P&L and other stuff. Then 5.1% both are at, so 7.6% is CARO. So a lot of things in CARO. Everywhere we cannot write according to information explanation. Also everywhere we cannot write that as provided by management. Qualification has to come out very specifically as qualification. So these are the problems with CARO. Then 5.1% if you see is AS1 and AS22. AS1 mein kya hai? AS1 is like accounting policies and background, as we said, not properly given. That is why AS1 is there. And then AS22, the calculation of the DTA and things like that, that becomes a bigger issue here. Then others are 3% to 2%. Other thing is 4.7% is 2 because that is something related to inventory, and all others are lesser. So highest non-compliance is Companies Act, under which we do the statutory audit, which is not good. So these are some observations in accounting standard AS1. We discussed already this significant accounting policies, and then various types of income expenditure that is not very clearly given. Valuation of inventory, the failure to disclose cost formula, standard, non-standard, broad heads of income, broad heads of inventory, all those things were not given. AS3 cash flow statements, we already discussed this. It was not prepared where it was applicable. Also, in case of subsidiary of listed company, it was not prepared. Then classification issues and other things, and also cash and cash equivalent definition issue, all these are in AS3. Then in AS12, if you see capital investment subsidy in the nature of promoter's contribution credited to P&L, which is not proper, instead of capital reserve. And then accounting for amalgamation, systematic basis for amortizing goodwill, disclosure in case of AS14, and also the detailed, notes with respect to accounting for amalgamation. All these things were the issues. Then AS16, borrowing cost, as you know, the cost of derivative transactions is added to the cost of borrowing. So that is not a qualified cost to be added as per AS16. And also there were these, capitalization issues with respect to home capitalization or something, which is borrowing cost getting added there. Segment reporting, identification of segment is one thing. Many places you write that only one segment is there, but then in those cases it is multiple. And then the segment asset revenue does not match with the main P&L. That's another problem. Related party disclosure, there's a failure to disclose corporate guarantee to banks or financial institution or credit facility. If you see AS18, it very clearly talks about disclosure of all the facilities, guarantees that is given. And it also falls, as such, it also falls under 185 if it is by directors and other parties. So it is actually dual disclosure. Non-compliance over here also goes into AS18 and also goes into CARO as well as the Companies Act. What is the problem? EPS, negative basic and diluted EPS is not properly disclosed or not disclosed on the face of the P&L. Now 21, 23, 27 all have a common problem. The consolidation, the procedures, the background of the company, how do you consolidate, proportionate consolidation, all these things are missing. So that's the problem with all the 21, 23 and 27. 24 is discontinuing operation, where the failure to disclose the information relating to net cash flows attributed to operating, financing and investing activity of the discontinued operation, and the separate P&L that you have to give before discontinuing, after discontinuing, and the complete disclosure, that's missing in many cases. So that's very necessary to give. Then intangible asset, the classification of R&D expenses between research phase and development phase. As you know that research phase is to be expensed out, and then development phase is only one which will start, actually going into intangible asset and the development. Impairment has a lot of issues. One with respect to identification, indicator, selling price, the fair value recognition, and also the overall, impairment loss and reversal and things like that. So these are the main things that are there in terms of all these accounting standards. I think quickly in 50 minutes, that's what I wanted to bring to your attention, because I understand all of us have been doing all the audits and all the financial statements from a long time, and we all are aware
now we are providing
here. Various intricacies here. So few of the quick reminders for this season, what you should remember and what you should focus on basically. And also those tricky questions on signing of financial statements, deliberately just, collated and put them up at one place. Some of them may have sounded silly, but then, these questions do come up. And we all ask each other. So there is, I felt that, there is no harm discussing with each other as well. I think that's all I have to add. Open for any questions, any suggestions, anything, any thoughts.
Padmashree, there is question in Q&A.
Okay.
You asked about company secretary, but they are asking, ma'am, if cost auditor is not appointed, then?
Cost auditor does not sign the financial statements per se. So if cost auditor is not appointed, so one thing I would like to state here is that at the end of the Caro booklet or at the end of the Caro clauses, one thing is written that this is not limitation to scope of reporting. So we are doing audit under Companies Act. Any non-compliance which is material enough can be brought out in the audit report under legal and regulatory matter, or if it is affecting the true and fair view, then on the basis of qualification place. So you can very much state that. Now different firms have different view. Some people say that the report, the 143 or the 139 does not ask us to report on that, so I'm not obligated to. However, on a very clean interpretation, stricter interpretation of Companies Act, any non-compliance on Companies Act should be brought out. Say, for example, if it is deposit section 73, 185, anything that has an impact, you can very much plead. Yeah.
Then second question is, may I have the PPT?
Yeah, I have PPT well sent. If directors are disqualified due to non-submission of ASC 4 and MDT 7 for more than 3 years, can auditor sign the financial statements for subsequent years? Auditor can sign, there is no problem in auditor. So I will put it this way: someone is defaulter, but then he wants to make good at some point or the other. So he wants to become good. Now he wants an auditor to sign the financial statements. What we have to do is we have to appropriately qualify the accounts that is under 164(2), and because it has a larger implication, because it is at the governance of the company, we have to consider if the true and fair view gets affected and the delay in the signing, and accordingly we can sign the financial statements depending on modified qualified opinion, whatever. But there is no issue that we should not sign. If
Last question
FS are
is-
not mentioning UDIN, is it invalid?
Actually, Padmashree, what happened now? There are confusion that whether you didn't have to be should write in only audit report, or it should be write on balance sheet and P&L as well.
Yes, yes, yes. So as per
That's right.
ICI, as per ICI announcement, it says that any report certificate issued by auditor has to carry the UDIN. So the right interpretation is, I am not issuing financial statements. It is management who is preparing the financial statements. UDIN just comes in auditor's report and not on the financial statements.
But if we are signing the financial statement, that means we are certifying financial statements.
You are certifying the financial statements with your report. So that is why your report should carry the UDIN. Whatever is
Yeah,
relating to financial statement, you are bringing out in your audit report. So report is your, if I put it in a simple terms, report is your property, financial statement is actually management property which you are counter signing. You are not the originator. So as per the announcement, this was, I think, in one of the forums, the previous ESB chairman also clarified that it has to be in the audit report or the certificate that issued by us.
Okay. But in bank, the clients provides audited financial statement, and sometimes they didn't contain the UDIN.
So
Yeah.
this is, I think, if I have understood the question right, no financial statement, if it is audited, should be provided without auditor's report. If someone is distributing audited financial statements without your audit report, which you have audited and affixed on it, that financial statement itself is invalid. You can't call it an audited financial statement unless you have an audit report on it.
Yeah, correct. So. So one more thing, Padmashree, whether it is mandatory to write DIN number in financial statement?
Yeah, yeah. C number, D number, all those things are mandatory. I think NCA has levied penalties on companies for not writing D number, C number, and all that. Up
And it's not
to,
required
for
to.
one D number, they have gone up to 5 lakhs of penalty.
Okay, so the director who are signing the financial, their DIN number should be on the financial statement.
Yes, yes, yes.
And is it compulsory to mention email ID or website of company on the financial statement?
No, no. So, two different requirements. One is if it is a stationery of the company, then the website, email ID, HO branch, whatever, has to be mentioned as per the requirement. But since financial statements are not printed on stationery of the company, so some people print it on company's letterhead, which is not proper. You are signing, so it should not be on company's letterhead. You can write the company's name, but it is not to be on the company's letterhead. So that is why it is not necessary.
Okay, fine.
There
Last
is a
question is, ma'am.
requirement under accounting standard rules that daily backup has to be taken. If a small company is not taking daily backup, is the auditor required to qualify the audit report? Yes, very much. So it is under your 143, 143.3, therein you say books of accounts are properly maintained, because this requirement comes from 129 of the Companies Act. So you have to qualify there. That proper books of account have been maintained by the company, except that daily backup has not been taken by the company.
But that is something new for me also.
And also audit trail from next year.
Yeah. Yeah. Okay. So they are saying that in large company balance sheets, they are mentioning on the financial statement, they are mentioning Udin. So whether it is
Now-
correct way or not.
There is nothing correct wrong here. The literal interpretation is this: if someone opts to print on the financial statement, we can't stop that. But is it necessary? Then the answer is no.
Actually, what happened, Padmashree, when we are making the Udin, at that time they are asking share capital, they are asking what the figures they are asking. That figure not is in our audit report.
Yeah.
It is in balance sheet only.
Yes.
So one school of thought is that if we are preparing the or making the Udin, generating the Udin with these figures, so we should write Udin below that figures also.
No,
Because in audit report
that's
nothing, because in audit report nothing is mentioned about the share capital
Yeah,
or
yeah.
the net
I agree.
PPE
But your audit report is encumbering your financial statements.
yeah.
So
So
then
what they are
the
saying
literal
we should write
interpretation will
Udin on.
we should
What they
write
are
only
saying that
under
your
share
Udin
capital.
should be on audit report as well as on balance sheet P&L also.
No, not necessary. So then we should write only under share capital schedule and turnover schedule.
Yeah, so balance in balance sheet and P&L, there both the figure will be there. No, we require 3 figures to give to
Not
generate
necessary,
UDIN.
ma'am. Whatever we generate, we have to put UDIN on it, because we have not generated financial statements. We are not obligated to write on it.
Yeah. Okay. So I think we have completed all the question raised by the
2 more have come.
participant.
If the backup is taken, but it is not possible to verify by way of log, still qualification is required. So how do you do the audit? If you can't see it, it doesn't exist. So you have to qualify. He says, oh, it is there, but you can't see it. So if I can't see it, I will have to qualify. I don't have any other choice here. Audit trail is required to maintain for public company from 1423. It doesn't say public company, it says all companies. There's no exemption here. Tally is not residence version, and we have been appointed as internal auditor in September 23. What should be the remark for soft trial, audit trail? Internal
Audit trail.
Internal
Actually,
auditor
what
doesn't-
happened, ma'am, in if Tally is not licensed person, then there will not audit trail will not be there.
Of course not.
In licensed
So
person
the
only
moment
audit
you
trail will
have
be
a
there.
pirated version, everything collapses. You can't see any report on that. That
No,
itself is
what what she want to say that in statutory report, in statutory audit, we have to report on the audit trail, whether in internal audit also it is required to be mentioned.
That's what I mentioned, that internal audit does not require any audit trail feature reporting. But if board has mandated that you look at the IT system, then obviously there is a very simple report that you have to write, everything fails. That's all, full stop. Because
Yeah, if internal auditor appointed by the board for taking care of due diligence part, then as the duty, internal auditor should aware the management that audit trail is not there, and it is not as per due diligence reports, and it is not as per compliance of CARO. But
no, but
it is
ma'am,
not mandatory.
the moment it is pirated software or it is not authorized software, no ITGC, nothing can exist.
Not
So it is
pirated, not ma'am. It is, there is different. Pirated and I have taken license, but I have not paid afterward. So my product is licensed version.
Your license
But I have
version,
not-
but you have not renewed your license.
Yes.
Okay, even
In-
if you have not renewed your license, you will not get the features that are latest available. So software will have to be updated. If you have not updated, then your audit trail feature itself. So what does the requirement of audit trail say? That you have to enable it. Once you enable it, you can't disable it. And then you should be able to see the logs. And that logs, no one should be able to mend, amend, or even touch it. Okay. So now none of these things would be doable in the given case. So if it is not doable, it is not there. And if it is pirated software, then it is completely story ends. But if you have authorized software where you have not renewed the license, then also all these features will not be available to you, because that was an older
Yes.
version. 4 years ago, if I have
Yes.
taken, things are not enabled.
That's true. So I think now you have answered all the questions, whatever there. So can I request Ansu to give vote of thanks to our second speaker also?
Yes, ma'am. Thank you so much, Pinky ma'am. And again, it was another, I think, amazing wow session. So I would like to thank Padmashree ma'am, who has shared important insights on today's topic, especially stating points like disclosing about the background, timing of signing the financial statements, mindful on classification of assets. Also, where we have to prepare our financials correctly, because it's so important that it is being seen by lenders, tax authorities, ROC. So it was a very enlightening and very interactive session where you have shared practical cases where we might do errors, since we generally have to meet stringent client deadlines. So thank you for taking out your time to be with us today and for sharing your valuable experiences on this topic. We're really grateful for the knowledge that you've shared with us and from you. Thank you so much, ma'am.
Thank you
Krupa
so
madam,
much.
one question is there. If you can answer that, this is the last question. And he has posted 3-4 times, so I think he wants the answer of that question. So if you can do that.
Where is it?
On last question, if an SEC doing F&O transactions,
No,
suppose
I've written, see,
purchase-
there is a para, because I didn't want to write the entire para of guidance note. I've pointed out that para 5.1.4.
No,
So
no,
if
what
he has
they are-
specific, no. What I suggest, if he has specific numbers, he can give and I'll work out and give him. That's what I'm saying.
Yeah, he has given the number that if he has given that the turnover is 200, but the profit and loss is 0. So then how is to show in ITR?
The ITR columns I'll have to see. He's asking about ITR or he's asking about tax audit limit.
He's asking about ITR. Actually, it is difficult to show in ITR because as
Yeah.
per ICI guideline, we have to take other turnover differently. And if you will come to profit and loss, then
Yeah. I thought he was asking on the turnover thing.
No, he's
So that's
asking
what I
about
wrote in my
ITR.
reply. So I'll have to
It's
see
very-
the ITR exact this thing and then give first.
Yeah, it is very difficult. All the CA or all the SECs are doing trial and error in this part.
Yeah, because some are taking only underlying difference.
Yes.
And some are then taking
Yeah.
both.
Yes. So if you have profit of 2,000 in one deal and you have loss of 500 in second deal. So as per ICAI, your turnover will be 2,500. Okay,
Yes.
but your profit is only 1,500. So if you will show turnover 2,500, then how you will come to the profit of only 1,500? What you will show in for 1,000?
Correct, correct. That's a problem because true. You'll have to show profit only ultimately. So what goes is only profit. We can't because the turnover is actually in accounts also we are not taking that.
In case of non-tax audit, it is okay, but in
base
case of tax audit,
this thing.
you are
So
how you will come to the no for that. In case of tax audit, what turnover? you
I'll
will
see the
right
idea
there.
that specific part and give you on that because I wrote on applicability of tax audit. Frankly, I didn't go into ITR. I'll give that back from the ITR.
Yeah.
Okay. Ideally,
Thank
profit report होना चाहिए, but again,
मैं तो बहुत
many
दिन से सबको ये
problems.
बोल रही हूँ कि रिप्रेजेंटेशन जाना चाहिए कि जैसे स्पेकुलेटिव बिजनेस का अलग कॉलम है, F&O का भी अलग कॉलम होना चाहिए
अलग होना चाहिए,
ITR
सही
में।
बात है, F&O होना चाहिए।
क्योंकि आपका यदि मेरा नॉर्मल बिजनेस भी है एंड F&O बिजनेस भी है, देन मैं दोनों को एक साथ में क्लब करके कैसे दिखा सकती हूँ मैडम उसमें?
नहीं हो सकता।
बिकॉज F&O इज नॉर्मल बिजनेस।
Yes, yes. It's not speculative.
ओके,
F&O is
सो और मैं
speculative.
यदि कोई चीज की ट्रेडिंग भी कर रही हूँ, सपोज मैं कोई ग्लास की ट्रेडिंग भी कर रही हूँ और इधर में मैं F&O बिजनेस भी कर रही हूँ, तो मैं दोनों का यदि डालती हूँ तो मेरा तो पूरे बैलेंस शीट इधर उधर हिल जाएगी।
नहीं हो सकता है, सही बात है। So ultimately I'll have to be in line with my P&L only. Ultimately what I report.
Yes.
I'll have
So
to be in line with P&L.
तो और यदि F&O का मैडम टर्नओवर निकालने का फार्मूला अलग है, देन देयर शुड बी सेपरेट मेनू
वो अदर
लाइक
इंफॉर्मेशन का
स्पेकुलेशन।
जो शेड्यूल है ना, अदर इंफॉर्मेशन अपना बिजनेस
हाँ,
प्रॉब्लम है उसमें किधर ये आना चाहिए, which is not affecting but just the information part.
नहीं मैडम, मैं तो बोलती हूँ कि वो जैसे स्पेकुलेशन का अपने लोग अलग से दे देते हैं ना, स्पेकुलेशन का कैसे हम लोगों ने अलग मेनू किया हुआ है, F&O का भी अलग मेनू ले लो ना, तो
सही बात
क्लियरली अलग से हो ही जाएगा कि एज पर ICAI गाइडलाइन टर्नओवर इज दिस मच एंड प्रॉफिट इज दिस मच,
आना चाहिए,
एंड व्हाटएवर द
ITR
हाँ अलग से ही मेनू आना चाहिए ना उसमें।
आना चाहिए। अभी है नहीं तो like try and be in line with your account, don't deviate, otherwise you will have problems.
They are saying today's session is one of the best, really practical. So very much congratulations to you both. You have made all the things attractive and informative, and taken all the practicals scenario in your, and covered in only 1 hour. You had covered all the things. So hats off to both the speaker of the day. Thank you again, Padmashree and Krupa Madam. And Krupa Madam, thank you to stay with us till second speaker.
I also enjoyed. I got a lot of knowledge on this, audit signing you did because we follow certain practice, but our practical inputs were very important, to keep in mind. Every time we don't sit with books. It was really very informative, even that last minute important precautions for audit. It was very interesting.
Thank you so much. Thank you.
So I
Thank you,
request
ma'am.
both the speaker to send us the PPT